Hello and welcome to Find Your Freedom, a podcast dedicated to helping you truly find freedom in all aspects of life. Join your hosts and their expert guests as they share practical tips and strategies for finding more freedom in your life. It's time to take control of your life and create the future you want. Let's find your freedom. Here are your hosts, Lenny the Boss and Omid Rad Investor.
Welcome to Find Your Freedom. We're super excited to have everybody, and now we're quite a few episodes in, and we have a little kit for everybody. So go to findyourfreedomrei.com/freedom kit, and this is a little kit that will help you get started in finding your freedom. So we're super excited to share this with all our listeners. Again, findyourfreedomrei.com/freedom kit. So now let's get started with our episode. I'm super duper excited. We have Ryan here. Learn like a CPA. So when you think about learn like a CPA, that is exactly what represents him. I think he's like the biggest emerging name in the tax side of the real estate space. He breaks things down into layman's terms where I can even understand, because I have the hardest time understanding taxes. And I think the one thing that why I enjoy his content is he makes it very simple for me to understand. So Ryan, we're super excited to have you on. Welcome to the show.
Hey, thanks for having me, guys. It's awesome to do this today.
Yeah, so why don't you just, for some of our listeners who aren't familiar with who you are, a little backstory about yourself.
Yeah. So I grew up, I was always an athlete, but not necessarily the brightest, smartest, at least I thought, but I was always really numbers focused. I went to school for accounting and finance, and that's where I learned a lot about just being able to read sort of financial statements, pro formas. I also I had a really good professor that used to do a lot of commercial real estate. So I was learning about real estate before I even got out of college. And from after college, I went to work at Deloitte Consulting. So I was doing consulting for large investment banks, hedge funds, syndications, basically making people who are already rich and wealthy even more rich and wealthy. And I, at one point, had decided that I wanted to help not the everyday person become wealthy, but the person in their family that was going to change their family tree. Because there's one person in each family line, I think, really, when you look at it, that decides enough's enough, and I want time freedom, and I want to change what's going on here. And so that's really the person that I target my marketing, my podcast, my content, and who I ultimately do services for. So I want to help that person achieve their financial freedom goals. I invest in real estate myself too. So at this point, I'm 4 properties that I own myself. I have doing RV/clamping in Branson, Missouri, and then also buying an RV park in Colorado. I'm also looking at stuff in Texas as well as Disney World. So
amazing. We got the great Ryan here, man. And I really love this guy because, we actually met, on a meetup, right? And, kind of clicked, kind of sent some messages to one another. We, went online and found each other, messaged with Facebook and IG and just stayed in touch, man. So, so network is one of the things that we definitely, support. So, Ryan, I love that you said, hey, man, I'm going to, take my knowledge and share it with, the everyday folk like myself to try to allow us to see some things that, we normally don't see. So let's just kick it off right there. Like talk about that a little more, man. Like why you just didn't sit there and say, hey, I'm going to keep talking to the wealthy, learn from them to actually maybe for some selfish reasons to make yourself better versus saying, you know what, I'm going to help the everyday person, understand that tax is their biggest liability and how they can take advantage of all these things out there.
Yeah, I believe it's just finding your tribe. And so my tribe just happened to be people that were just like me. When you look at it, it's a lot of people who, their parents both had W-2 jobs or one parent had a W-2 job, and in their family, that's all they know is to work for somebody else. But a lot of us have realized that, hey, you can achieve financial freedom through buying a few rental properties, owning a few side hustles, And, even if you don't make the 6-figure salary that you're making at corporate America, you have all your time freedom back. So maybe you make 3/4 of that or whatever it is, but you have 50% of your time back. And those are the types of people that I wanted to work with. And that's who I've been able to align myself with.
So I guess you have a lot of clients who maybe are thinking about that transition, or you're advising them on the transition. What's the biggest hurdle for them? Like, I know a lot of people, just like for myself, I was super scared to kind of walk away from this 18-year corporate job that was comfortable, the golden cuffs. So what do you advise people who are kind of hesitant to make that move?
So a flea, right? A flea can jump up to 36 inches from the ground, but a flea covered in a 4-inch jar can only jump 4 inches, right? Because he's contained to the jar. If you put that same flea that's only been jumping 4 inches out of the jar, he can only jump 4 inches still. And a lot of us have that mindset of being only able to go this far because that's what we've seen. That's what our friends are doing. That's what our family did. Hey, let's work this job so we could have a nice house, car, kids, etc. But we have so much more potential than that. I think COVID especially put a new wave on a lot of people where they really value their time freedom and really not having a boss. I have a question for you guys. Do you think a caterpillar knows that he will become a butterfly?
Interesting question. I go first. I'm going to sit here and say no.
He sees all his other caterpillar friends eventually turning into butterflies, and he's like, "Is that me too? Am I gonna turn into a butterfly?"
I mean, for me, it's if you surround yourself with people who are very successful or doing something, it inspires you to do the same thing. And I think, like, when I think about my friends who are in the real estate space versus the ones that are not, the ones that are in the real estate space are the ones making the moves, and they have higher trajectories as far as, like, what they're able to achieve versus my friends who are doing the traditional W-2 because that's what's comfortable.
Right. And I actually had to Google this a few days ago, but the answer is yeah. Apparently the caterpillar knows that he will become a butterfly.
Wow. Guess I was wrong. Boom, boom,
Wow.
boom, boom. No, that's really cool because it goes in line with Amit, right? What he just said is understanding your surroundings, which is very important. They say, who you hang around is what you're going to become, and obviously, caterpillars going to become these beautiful butterflies, and that's super awesome. So let's just stick there just a little bit. And, with this, W-2 an employee, right? You're saying, hey, this is not the best life for me. And I want to sit here and move to, at some time, being self-employed. I remember my tax guy, one of the first businesses I created, I thought I was doing something, saving some taxes. And, he came to me, I came to him and he said, is this a hobby or is this an official business? And I looked at him, I really wanted to punch him. I really want to know the truth because I just was like, what you mean, is this a hobby? That was very highly disrespectful. But, I hear you talk on official business. So I guess, can you explain that? Like I'm pretty sure you ran into that where someone like me came with this thing and it's really a hobby more than a business.
Yeah, that's a great point. So when you run a business, and so rental properties are businesses, right? So we should be having financial statements. We should be reviewing our books. If you ask me monthly, to really know what's going on. But a lot of business owners, real estate owners, are treating their businesses like hobbies. That's probably where you got it from. They go through the entire year without any record keeping, any financial reporting. And then when it comes time for tax season, they're like, I need to scramble and get everything together. If you're doing that, it's not running a business. That could be more so a hobby, right? Because you're not, in my opinion, you're not taking it seriously because you don't know your numbers. And so how are you going to know, whether your rental property is profitable or not, outside of just cash being in and out of your bank? But if you can't tell me, hey, this is what I made the last 3 months or the last 6 months, you can't really go transcend and go anything further. Because if you're looking to pull outside investors, they're going to want to know your track history, right? Like, what are your current projects doing? What did you estimate or pro forma out your projects to be versus what they currently are? You can't know any of that without the numbers. I'll piggyback off of that too. I think the number one mistake that I see people make when they're transitioning from W-2 to self-employed is they want to write off everything when it comes to expenses. And so the biggest, and I don't mean to like poke fun at realtors, but they're notorious for doing this, where they'll make $120,000, $150,000 a year selling houses, and then they'll go buy a $50,000 or $60,000 car. Well, when you go to the bank and you make $100,000, but you bought a $50,000 car, the bank's gonna be like, well, you didn't make 100, you wrote off this vehicle, and so the bank's only gonna qualify you for $50K for financing for buying rental property. So I think when you're just starting off, you have to be very aware of what are your loanability, what are you bankable for. So right when you leave that W-2, you're not having the W-2 come in, it's going to be very hard to get loans, which means you're going to be pushed towards either doing bank statement loans or debt service coverage ratio loans, or you're just going to have to partner with people, or you have to do hard money. And so I think that's probably the number one mistake I see when people go from the W-2 to self-employed full-time.
So let's jump into that a little bit. I know there's just a lot of rookie mistakes for taxes because people don't necessarily plan until, hey, I bought a property, I bought 2 properties. Oh wait, I need somebody that's going to help me with the financial strategy piece. So what are, I guess, some best practices specifically? Somebody wants to get started. Let's say they're interested in short-term rentals. So they still have their W-2. What is like the best practice as far as like transitioning over?
Yeah, I mean, definitely, I would say automation as much as possible before you leave. I see a lot of people more so on like co-host or arbitrage side of real estate where they're really just creating themselves another job when you look at it. I was talking to somebody at our mastermind meeting last week by the pool. We were having a few drinks, and I said, and he had asked me because he had just got laid off from a big tech company. And now he's looking into doing co-hosting full time. He wants to take on 4 or 5 clients a month. And he's like, well, what was the biggest transition piece? And I said, well, look, you go from having one boss to potentially having dozens of bosses. If you're self-employed, you don't know how to manage your time and create that separation between you as a business owner and your customer or client. You could go from taking orders from one person to taking orders from 50 or 100 people. And so automation is key there. I would say also too, kind of know your exit plan and know your numbers. Like, hey, this is what I need to live off. I need 10K a month, 20K a month. And then once you have that goal or that end piece, figure out how you can work back to do that, right? So in the bigger pockets and stuff, a lot of people are talking about doors. How many doors do you have? 50 doors. Well, it's like, I could have one project that makes the same amount of money as your 50 doors. And so you have to understand what is that number that you're going after? What is your financial freedom number there?
I love that. And thank you for sharing because, I tell people all the time, it's not about the amount of doors you need because that gets glorified all the time. It's about what you just said is your lifestyle. Sum up your bills, sum up, your car notes and what you do and have that number, and you can get a few properties can get you right there. But let's just stay with the properties, man, and let's move over a little more on the tax side, right? Because, if you don't know, listeners, your biggest expense in life are taxes, right? And let's stick here, I guess, in the short-term rental world. I guess, give us some common, tax deductions that, we can take.
Yeah. So I think a lot of it is about really understand that in a short-term rental business, pretty much any expense that's ordinary necessary to operate in that short-term rental is going to be deductible. So whether that's, your repairs, or maybe you're paying co-hosting fees, or you have occupancy taxes, mortgage interest, property taxes, insurance, all those are going to be deductible. And most people should understand and get those, right? So if you go on the IRS website, you Google Schedule E, which is where rental properties are reported, there's about 15 different deductions that they have that are there for you to take. But that's the ones that they want you to see and the ones that they want you to take. What they don't tell you about is all the other sort of deductions that you can get, different types of strategies. So, I run 3 businesses in the real estate world, and I run it from my computer and this device here. But I don't see a lot of people actually deducting part of their phone bill or their data or their Wi-Fi or whatever, their laptop, right? A lot of people are missing those deductions. So there's a lot of expenses that we have that might seem personal in nature, but we can actually really use those in our business as long as we're able to spin it off as if it was ordinary necessary to that business.
I love that. I think the ordinary necessary is probably something that people need to speak about more often so that they're familiar with what it is. And to me, it's still kind of like not super clear. It's so maybe can you explain what that is?
Yeah. So ordinary necessary, it really does depend on, your course of business and kind of the people you hang around with. So if let's say I'm a carpenter and I'm making, let's say, less than $100,000 a year, and I'm self-employed carpenter, and all my other carpenter friends are driving, $15,000, $20,000 trucks to go from jobs. If I buy a $100,000 Raptor, is that ordinary necessary in the course of my business? Probably not, because I don't need a $100,000 Raptor to go back and forth between property to property. All my other friends got $20,000 cars, right? But let's spin it. Let's say I'm a $1 million doctor, anesthesiologist, or maybe I'm a $1 million realtor. I sell $1 million worth of homes every year. All the other realtors have $100,000 cars because that's part of that gain in business. So now, is that $100,000 Raptor ordinary necessary? The argument could be yes, because everybody else has that in the course of business there.
Hey, let's stay there, man, because I like to eat. Right. And, this is a good one, man. I like to eat. So, and honestly, there's a wide range of food in restaurants. So you can go to the Del Frisco's and spend, $60 or $70 on the steak. And then you can sit here and go to somewhere like Outback, right? And spend, I don't know, $15 or $17 for a steak. So are you telling me, right, it's not ordinary or reasonable for me to sit here and take out, maybe on a business dinner to Del Frisco's versus to Outback, and nothing against Outback or anything like that, but let me just throw my disclaimer out there.
Well, that's what I'm getting at is, and that's what the tax court will actually look at is your status, really. And that's the conversation that I had with Bill Faith, because if you've ever been out to dinner with him, he likes to eat nice. Let's just say, he just has a very expensive taste, right? So it's not out of the ordinary to buy like $100 bottle of wine or $200-$300 bottle of wine. Is that ordinary necessary? You have to look at the factors, right? He's more likely to eat at a Connor Steakhouse than like an Arby's, right? So
I love that.
That's good for me to know, because I love my steaks, right? And I just had to throw that out there, but you could go ahead. I love my steaks. So, we're going to the steakhouse, dude. Del Frisco's on.
Yeah. Yeah. So I think about, what I do, and I like to have drinks. So like at conferences, I like to drink at these conferences, and somebody's expense can be different than somebody else's. So sometimes I look at my bill and I'm like, oh, what happened last night? And so, I'm just thinking, I guess, is that something I can write off? But, maybe let's transition into like another piece. So I know just like the tax write-offs with cost segs in general, maybe you can just walk us through like what a cost segregation study is and like the benefits for the average person.
Yeah. So in order to understand that, you have to figure out that every rental property that you buy gets assigned a value. And so let's say I have a purchase price of $390,000. Well, that $390,000 is getting depreciated over time because the government says, hey, the materials of the building are actually deteriorating over time. Depreciating over time is actually the word that they use. And so if I have a $390,000 building, well, I get $10,000 a year in depreciation that goes towards my rental income. So if I made $15,000 on the property, I have $10,000 of depreciation. Well, I only have to pay tax on $5,000 because the $10,000 is going to offset the $15,000. And that's arbitrary, right? So if it's short-term rentals, you're going to be dealing with 39 years. If you're doing multifamily or long-term rentals, it's going to be 27 and a half. But there's a way to speed that up, right? So if you're in high tax brackets and you're actively buying real estate and you're looking to use that for financial freedom, there is an incentive to want to be able to speed those deductions up. So on a $390,000 property, instead of only getting $10,000 a year, I might get $70,000 or $80,000 in depreciation deductions that first year. And that depreciation is driven through the cost segregation study, because if I don't do the study, then all my building gets depreciated over 39 years. as opposed to being broken out into different class lives. So the furniture, the millwork, the tables, the countertops, all that stuff depreciates faster than 39 years. And so on a $390,000 property, I might get $80,000 worth of depreciation. And so now I'm taking $80,000 in year one as opposed to $10,000. And if you want to figure out your savings, one of the good things you could do is really just take that depreciation and multiply it by your tax rate, assuming you're able to deduct the losses, right? So if I'm in a 40% tax bracket and I get $80,000 of accelerated depreciation, well, I just saved $30,000 plus dollars that year in taxes.
That's great. And let's talk about this cost segregation because, education is very important. And this is what I want to know. So this strategy of cost segregation is optional. It's not something that you have to do. So what would you tell the person, like who should use this strategy? Should everybody do a cost segregation or should only a certain people with different goals?
Yeah, good point. So there are people that should not do it. There's people that should do it. Generally speaking, the people that should do it outweigh the people that shouldn't, at least in our world, at least in the short-term rental space world. And so I've done I actually have a tax training course that's kind of releasing soon here. And part of when I did this course up, I identified, who should do one and who should not. And what I remember from going through the course is that the people, I would say there's about 4 to 5 different factors about who should do one. And then they're also this flipped for people who shouldn't do one. So the first thing that we're going to look for is, are you in a high marginal tax rate? And so to me, that's going to be probably about 22 to 24% or above. So if you're, go online, type in, 2023 tax brackets, 2022 tax brackets, and see where you're at. If you're 22% or above, then, you check that box. And the reason why is because that's what you're getting from a deduction piece. So if I have $100,000 of depreciation from a property that I bought, if I'm in a 37% tax bracket, I just got $37,000 of tax savings. If I'm in a 22% tax bracket, though, I only got $22,000. Same property, same location, same everything, same purchase price. But because of my tax bracket that year, which could fluctuate depending on how my business did I get married, did I have kids, whatever it is, that could fluctuate year to year. So that's the number one checkbox there. The number 2 checkbox I would say is your purchase price. Definitely your purchase price. So buying, a $300,000 property compared to $1 million property is going to be very different in the benefits. And you can calculate that a little bit the same way. And I teach that in the training is take your, your depreciation deduction on $300,000 property. Let's just say I get 20%. I have $60,000 times my 20% tax bracket versus $200,000 times my 20% tax bracket. That is a big difference there, right? The third thing I would say is your holding period. So how long do you intend to hold on to the property? Because the depreciation is you do end up having to pay that back some point in time. But the idea is you're taking advantage of what's called time value of money. If I get $100,000 of depreciation year one and I'm in a 30% tax bracket, let's just assume in year 5, when I go to sell the property, I'm in the same tax bracket, right? Well, I got $30,000 of deductions in year 1, and I might have to pay the $30,000 back in year 5, and you could strategize and you can plan around that. But just that alone, I basically got a $30,000 interest-free loan from the government. And that $30,000 that I got, as long as I reinvest that into my business and my real estate, I'm going to have the money to pay that back when I go to sell it in year 5. So I typically recommend people, if you're going to do it, you want to have at least a 3-year hold period, but more so probably at least a 5-year hold period for it to make sense. The last attribute that I would say, I mean, there's more, but the last more important one I would say is what is your participation in the property? So for me, I don't self-manage any of my properties. I hire either VAs or co-hosts or partners. And so my deductions are going to be limited because if I don't self-manage the property, I'm not going to be able to take the losses against my W-2 or my business income, which reduces the overall savings that I'm going to get. Versus a lot of my clients, I would say 90% of them do self-manage and do meet those thresholds. And so it's way more advantageous for them to do cost segregation than it is for me because I don't self-manage my properties.
So can you speak on that? Because I think there's sometimes confusion around like participation and understanding, hey, I'm a W-2 earner, but I want to take advantage of some of these tax advantages. Walk us through kind of like the differences of how you can, I guess, as a W-2 earner.
Yeah, so for a W-2 earner, specifically for short-term rentals, they're going to want to meet two tests. So if you take your short-term rental, right? So I have one in Ohio. You're going to sum up the amount of days that is rented and divide that by how many different unique guests that you have. And as long as that's 7.0 or less, you check box number 1, right? Which most short-term rentals do, right? I mean, I do probably 3 or 4 day stays for the most part, like stretched out weekends for the most part. I'll do a Friday through Monday, and then I won't do it again until another Friday through Monday, something like that. So that's box number 1. And then box number 2 is going to be you have to do what's called materially participate in the property. And so if you're unfamiliar with this, like I said, I have dozens, hundreds of hours of podcasts, YouTube videos going through this specific topic. I also have helpful tools that'll help you track this time. But basically, as long as you materially participate in the property, which is also just known as you pretty much self-manage it yourself, then you're going to be able to check both boxes and be able to take any of your losses against your W-2, your business income. To hone in on the test, really, there's 2 big ones. So you can either do 500 hours in the properties across all your properties. So typically don't see 500 hours with one property. That's a pretty far stretch, but for somebody who has 3 or 4 properties, that's easily achievable, 500 hours. Or if you just have one property, then you're going to be looking at a 100 hours at least and more than any other person. So 7 days or less average stay, 100 hours and more than any other person. So if I have a cleaner, a handyman, a contractor, somebody that's working in a property, I have to prove that I spent at least 100 hours and that time was more than any other person. And the next question that I commonly get is, well, what if I have a cleaning company? And we actually dug into the tax code of what it means to be an individual. And it does say in there, if it is a cleaning company, that you're only competing against each individual cleaner, not the whole cleaning company as a total. So just FYI.
That's some good information right there. And, once again, let's stick here. All right. So, you talk about this 500 hours you have to spend, and the 500 hours need to be more than anyone else spent on your property, cleaners, carpenters, handymen. Now, is that the accumulation of them, or is that singular?
Each person is on their own island. So let's say I have 100 hours. My cleaner has 80. My contractor has 50. Even though their hours are total more than 100, I still win because I have at least 100 or more than any other person.
Okay. No, that makes a whole bunch of sense.
Okay.
Absolutely. And I guess a follow-up, to that question is, we check all these boxes and, we believe that we should be taking advantage of this. What tools, can we use to sit here and track this so we can make sure that if, God forbid, the IRS start coming knocking at our door, that we are well prepared for that fight?
Yeah. So on the IRS website, they do have basically like a very sloppy sort of tracker that you can use. I've already done the liberty of taking that, making it look a lot nicer and making it make more sense, and also including the hours that count versus the ones that don't count, as long as, dozens of hours of instructional videos and podcasts. And so that'll just be, any of my social media. You just got to go find my, I think I call it my top 5 tools bundle or something like that. But in that bundle, you'll get my material participation tracker. You'll get my rental property financial statement. So you can, if you have really sloppy books, you can go back and fix your books. I have a deal analyzer in there, and then I have other helpful tips and tricks. It's all in that one bundle, but you can, and it's an Excel download. So if you're familiar with Excel, you could, upload it to Google Sheets so you could track it on the go. There's also an app called Reps Tracker, but you have to pay $10 or $15 a month for it. So I made my own, and I give it out to people for free.
I love your bundle, by the way. I have a in my Google Drive, so I've kind of saved it because I think it's a great resource. And
thank you.
You got the 5 tips, and I forgot what the other one was, but yeah, it's a great tool. So for all the listeners, it's a quick, easy download, and it provides a lot of great value. So highly recommend that. I want to jump on the concept that you shared about time value of money. I think that's not talked about enough. So a lot of people are like, oh, I save money on cost segs, but they don't really understand the time value of money. So maybe explain that strategy and why and how like cost seg kind of ties into that.
Yeah, time value of money. I mean, that's what I learned in with my finance degree. But if you look at any sort of uber successful business or a rich person or a wealthy person, that's all they use is time value of money. Think about it. So they went out year one, borrowed a bunch of money to buy income producing assets at a fixed interest rate, and just snowballed and accumulated using that debt to buy assets with the time value of money. Right? I'm going to borrow money at a 4% interest rate, and then I'm going to be paying it back over a year of 30 years. That's time value of money. Lenny, if I owe you $10,000, do you want that tomorrow or do you want it in 10 years?
Well, it all depends. I think
right.
Probably, well, for now,
assuming you get paid the same amount of money, do you want it now or do you want it in 10 years?
Yeah, you give me mine right now.
Exactly. But as business owners taking on debt, we get to decide that we get to pay that back over 30 years, right? Or 15, 20 years, whatever the terms are. And that's time value of money, right? It's borrowing that money in year one, using it to buy and accumulate more assets and employ more people and businesses, et cetera, and then paying that money back over a stretch of time. It's a super powerful tool that's been, stands the test of time and that has been used forever. I mean, think about us, I bought multiple properties sub 4% interest rate. And now when I pay that money back 2, 3, 4 years later, the inflation right now is 8 to 10%. So the money that the bank's receiving now is worth way less than when I borrowed it. That's time value of money.
Oh man, you were sure. Woo! That get a boom, 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 boom. Listen to what he just said. I borrowed the money at 4% years ago, under 4, and now with inflation, the bank is really kicking themselves in the butt right now. They're saying, why did we lend Ryan all this money? Because it is just so little. So Ryan, I mean, like, for the listeners, man, for myself, probably for me, what should we be doing when it comes to taxes and being well prepared for our, CPAs? So, everybody is happy and thorough and ready to get that thing done.
Yeah, I would, I'll circle back. First thing I was saying earlier is know which avatar you are. So if you're that person who's newly self-employed or you're just getting started, think twice about writing off everything under the sun because you're not going to be vulnerable or bankable, right? But if you're that person that's that seasoned investor who has a steady W-2 or a business that has a track record, and you're able to get loans based on your income, then you can expense everything that you want to because you're going to be able to get that loan from the bank. And so I'm kind of like almost there but I'm not. I'm still waiting on other years of business tax returns. But understand where you're at first, right? And that's going to determine what sort of tax strategies that you want to use throughout the year. As far as getting ready, it is super important. So the three things that I talk about why it is important is, number one, speed. So speed is everything in business. How quickly we can operate, how quickly we can turn over properties, how quickly we can communicate with guests. Speed is everything. In the tax world, I want to know, hey, am I going to owe or expect to get money back? And I want to know that as quick as possible, right? I need the tax returns filed so I can do a refinance or buy another property. I need to get the tax returns done so I know what my business looked like the previous year. And so if I owe 30 grand I wasn't expecting, then I can tweak it, right? I need to be able to tweak it. But also, too, even getting a tax refund is saying, hey, if I knew I was going to get this refund, I should have had this money throughout the year rather than getting it back on April 15th. I should have adjusted my tax withholdings throughout the year. And so speed is super important when it comes to tax time. So that's why you're going to want to have, all your documents. If anybody's interested, I actually have a list of all the stuff that you should have for tax time. It's not published anywhere, but I can send it to you if you're curious about this list. I can give it to you guys, facilitate it. But speed is very important, right? And then the other two things really just reassess, your prior year's portfolio, right? one of the exercises that I'm doing with a lot of clients right now is taking your whole portfolio, putting it in an Excel sheet and saying how much for, let's say I have 5 properties, right? What is the net equity in each property, meaning the fair market value minus the outstanding loan balance? Take that number, divide it by your net operating income after debt service. So if I have a property, let's say I have $300,000 of equity in that property, but it's only making me $10,000 a year net of all expenses. Well, that's a 30-to-1 ratio. For every dollar that I have invested, right? It takes me $30 of my own money invested just to make $1 that year. And so what I would recommend clients is, hey, that you should get your equity out of that asset and put it into something that, maybe has 20% cash on cash return, because that means you're getting your money back in 5 years as opposed to 30. Because if you have $300,000 of equity between your down payment and forced appreciation, but you're only making 10 grand on the property, again, that's a 30-to-1 ratio. Typically for long-term rental, short-term rental, if you have a long-term rental with, I would say, more than a 12 to 15 year ratio, it's a good time to sell and get into something new. For a short-term rental, it's more like 10. I would say, and this happened all the time in the Smokies. You got somebody who, I have multiple clients that bought $250,000, $300,000, and now the house is worth $800,000, right? So they have $600,000 of equity in a property that's only making them $30,000 a year. They'd have to rent that cabin out for 20 years just to break even on the amount that they have invested. So then the next question becomes, well, can you exit timely, tax efficiently? Can you get it into something new? Oh, and by the way, you have to combat probably the higher interest rates now. But these are all sort of considerations that you as an investor should be doing. And you really can't do that without proper financial and tax planning. So.
Wow, that was pretty complex. So, I love like that concept around figuring out, does your particular property, is it the right time for you to maintain it, or is it make more sense to 1031 it into something else that makes more money? So with interest rates, like where they are now, what is like a typical strategy that people are using currently? Like, are they doing more holds based on some of those factors, as far as, let's say they have a lot of equity? Because I feel like there's a lot of properties with a lot of equity in these deals if they bought a couple years ago. So what should somebody be doing in that sort of position?
Yeah, so I have proprietary calculators that we use. We have different models. So for example, we'll analyze a property and we'll look at all options. So, just straight up hold it. Maybe you refinance and you buy something. Maybe you refinance and you hold the cash, or maybe you do 1031 into something new, or you just sell it outright. And so based on your, you have to know the numbers on the front end and what you're getting into, obviously, as far as interest rates, terms, etc. But that's the type of analysis that you have to walk through. I would say right now, what a lot of people are doing, and this is working right now, and the reason I know it's working is because I've done it. What people are doing now, because seller, it is a buyer's market, in my opinion, right now, because the way interest rates are going. And I go to some of the local meetups in Chicago, where I'm from, and the guy last time was presenting, hey, the average days on market was 23 days a year ago. Now the average days on market is 78. It is 3 times the amount of time in my local market that people are waiting to sell houses, which means sellers are getting antsy, right? They're dropping the sale price. They're dropping the asking price. They're more open to terms, right? Whereas 2 years ago, you had to buy something sight unseen, waive the inspection, waive the appraisal contingency, no escalator, no nothing. You didn't get nothing. You just had to bow down to the seller. Well, now things are getting a lot different. And the best strategy, I think, right now for somebody who's looking to get their first deal or maybe their first home is go find something at a discount. I'm working through one of my friends right now. She's buying a house. And I said, hey, this house looks good. I know this thing will appraise for more than what you got it locked up for. Contract price $300,000. I was like, that property will probably appraise for $325,000 if I had to guess, because it's in my market and I know it. And sure enough, the thing appraises for $320,000. And so what is she able to do now? Well, hey, here's what we could do. Why don't you gross up the purchase price by $20,000, knowing that the bank will be happy because it'll meet the terms there. It'll appraise at $320,000, right? So gross up the contract price by $320,000, and then tell the seller, hey, I'm going to buy it for $320,000 instead of $300,000, but I'm going to need $10,000, $15,000 towards my closing costs. And that's a way for her to get all of her closing costs funded from the seller through seller concessions. And so this is a strategy I'd recommend for a lot of people doing VA loans. VA loans, closing costs are super expensive. If you can find something that you know you can get at a discount and it'll price higher, you can, once you have it under contract, gross up the sale price a little bit and ask for its concessions, because I would rather lump my closing costs, any sort of rehab costs, money going into the loan balance, pay that off over 30 years, time value of money, rather than come out of pocket for those closing costs.
Ryan, that was genius. My God, listeners, rewind that back, right? Listen to what he just said, because the market, changed, I'm going to say, and he just gave the most genius answer that I have heard in probably, the last 5 years, honestly speaking. Man, that was so much value. So, Ryan, let me ask you a question, man. All right. What does find your freedom mean to you?
Find your freedom means you do what you want on your own accord, I think. You can still work at W-2, you can still have a boss, but you have the option to leave. You have the option to just say, enough is enough, I'm done. I think finding your freedom, it definitely looks a little bit different for everybody, right? Some people might be happy with 10 grand a month passive, 50 grand, 20 grand, whatever that is. And that's why it's important to dial in what that focus is, right? You want to begin with the end in mind. There's a book called The 7 Habits of Highly Effective People. The second habit is begin with the end in mind. Predict, look out what you want that to be. Hey, I need 10 grand a month to leave my job. And then take the steps to work back to get there. Hey, I could have 2 short-term rentals that are making 5 grand a year or 5 grand a month. I could have 50 long-term rentals that are making $200 a month, right? Whatever that is, begin with the end in mind and work back. And I think that's what find your freedom is, because people will take different paths to get to that 10 grand a month number.
Wow, Ryan, that was awesome, man. How can we find you? Like, where can we connect?
Yeah, I'm on Instagram, Twitter, TikTok. It's going to be at Learn Like a CPA. I have a Facebook group called Tax Strategies for Real Estate Investors. We're almost at 5,000 tax smart investors in that Facebook group. Yeah, and you'll see me. I have a few different guest speaking appearances this year. So last year, I think I did about 6 or 7 live speaking engagements. Spoke at the SGR Wealth Conference in front of 850 people last year. I will be doing that again this year. Ding, ding, ding. So you'll see me in Nashville, March 20th through the 22nd. I'll be there. And then I'm also looking to just book more speaking engagements later on. So if you have a conference that you want me to come speak at, please reach out. Happy to do so.
Oh, that's fantastic. That's fantastic. So, here at Find Your Freedom, we don't have guests. We have friends. And how we like to do is we like to do this big boom session where we're going to, interrupt some speakers here. We're going to tear down some eardrums. So what we're going to do is on the count of 3, 1, 2, 3, in uniform, all of us is going to say boom. So are you guys ready?
Yeah, let's do it.
All right. I got the hand nod, listeners. All right, get ready. Turn that volume down. All right. 1, 2, 3. Awesome. Listen here, man. We just had the great Ryan on, and all the gems that he just dropped, especially that last one. I'm telling you, you're going to want to rewind this episode back and listen to any and everything that he said, because he gave you so many check boxes to check off to know what kind of strategy you should be following. And Omid and I, we sat back and said, man, outside of our educational platform, what else can we do for the listeners? So we decided to say, hey, how can we provide you with a Find Your Freedom kit that's going to help you do that? So just go to findyourfreedom.com/freedom kit. Once again, Find Your Freedom, REI.com freedom kit. Download it, get it. Believe me, you're going to love it. Now, make sure that you listen to this episode and provide us with an honest 5-star review. Leave some comments. We'll go in, answer any and all, and make sure you share this, subscribe. And with that being said, until the next episode, talk to you soon. Peace.
Thanks for listening to Find Your Freedom. Be sure to subscribe wherever you listen to podcasts. While you're at it, please help us spread the word by leaving a rating and review and sharing the podcast with friends, family, and colleagues. Until next time, get out there and find your freedom.